I've called this article Trumpty Dumpty. If you've missed the US presidential antics over the past month, you might consider yourself quite blessed. The decisions and statements coming from the whole of the Trump administration have been unsettling, to put it mildly. When Trump was voted in at the end of last year, we experienced a glimpse of the future when US equity markets shot up in expectation of a new era of tax cuts, the removal of red tape, and an end to taxpayer waste in the States. This sudden rise in markets was termed the Trump bump, and it certainly benefited our client portfolios. Indeed, it wasn't just US equities that rose in hope. Indexes around the world experienced a pleasant jump. Of course, there were the whispers that actually the economic policy of Trump could trigger inflation and potentially a frothy market. However, the mood was mainly good. From the end of February, all that has changed. Isolationist policy from the White House and some incredible arrogance towards former allies has led to fear in US equity markets. This is really the important point. Markets don't do politics. They are heartless creatures that simply seek stability and a narrative that suggests better times ahead. When your president starts imposing huge tariffs on imported goods and your global export market starts retaliating at the same time as fired government employees are being thrown into the jobs market, you know your domestic economy is not going to be in for a good time. And so we've entered the period that is now being called the Trump dump. But how bad is it? How much worse is it going to get? And how is this affecting our client portfolios? Clients who've been with us for more than 10 years or so will be used to watching the UK FTSE 100 index and pretty much being able to guess how their portfolios are doing from there, without the need to even log on for a valuation. All of this started to change in the past decade as the index became skewed towards old world stocks centred around energy and some notable armament manufacturers. During the COVID pandemic, the FTSE 100 really lagged, and we were extremely glad that all of our client portfolios were much better diversified to pick up gains in other markets and asset classes. It was almost easy to beat the FTSE, with even more cautious portfolios outstripping its growth. However, there's one thing that this old index responds extremely well to, and that, sadly, is war and the threat of war. This is one reason why the FTSE 100 has enjoyed such a disconnected growth story in the past few years when other markets have appeared to struggle. The other reason is that the FTSE 100 was extremely unloved by international investors after the UK's decision to leave the EU. This index was trading at a remarkable discount against its US and even European competitors. In the past few years, investors have piled into this index to try and take advantage of the mispricing event. Now, when considering the value of an index or a stock, investors will consider its price to earnings ratio. It's called the PE ratio, and this is broadly the amount of years that it will take an investor to get their initial capital back solely via dividend returns. So, for instance, if a stock has a PE ratio of 15, it would indicate that you might expect to be around 15 years in dividends before you get your initial invested capital back. In 2023, US markets such as the S&P 500 and NASDAQ were trading at 25 plus PE ratios, and this was very expensive. During this period, the FTSE 100 was trading at a PE closer to 10. Indeed, its smaller cousin, the FTSE 250, which represents more domestic UK companies, was also unloved at around this ratio of 10. So by the end of 2024, the FTSE 100 PE had risen to around 13. This still suggests some value against other international indexes, but remember, it is very skewed towards those old world stocks that could fall out of favour at any time. And spare a thought for the poor FTSE 250, which is still stuck at a PE ratio of about 10. So where am I going with all of this? Well, my point is that the FTSE 100 has seen something of a freak return in the past few years, and certainly in the past few months. We do hold FTSE 100 funds within all our clients' portfolios, although the ethical portfolios clearly need to avoid the very components that have been doing quite so well. However, we can't allow our clients' wealth to be gambled on the fortunes of one index that we honestly struggle to see having a long-term future in its current weightings. This has made it very hard for our portfolios to match anything like the FTSE 100 returns in recent times. This is where it's so important for us to zoom out a little bit and consider how markets historically move in cycles. Now, on my written article on the website, we've put a little chart up. That following chart has been taken from an independent U-Scan report, and it shows how our pro-ethical level 3 model portfolio, which is in green on the chart, has performed since we built it right back in 2014. Yes, you can see that the recent FTSE 100 tracker that it's being compared against in red has enjoyed a great run recently, but look at the damage that that tracker suffered back during the 2020 pandemic. The PE3 portfolio also contains no oil, gas or armament stocks. And the little green dots, if you do decide to have a look at the chart on that line, are the places where we made adjustments to the portfolio. Let us imagine that some kind of peace deal is done to stop Russia from attacking Ukraine. And let us also imagine that Mr. Trump takes a look at his portfolio values in the coming days. Suddenly, the game may change, with oil prices dropping and tariffs being slashed. The US president is very persuasive, as we know. Is there a chance that he could exert the same pressure on his central bank to cut interest rates, or on his regulators to loosen business regulation in the US? I think there is. Last night, we witnessed Mr. Trump buying a car from his friend Elon. I squirmed with embarrassment as I watched, yet I kept watching, because something really stood out for me. And that was that these two alpha males might just realise that they've overdone it, as they see the damage being inflicted on their wallets by a very angry customer base. Nothing talks like money, folks. Gosh, that would be a good name for a podcast, wouldn't it? Your Money Talks. Just imagine if Thomas & Thomas put all of that up for their clients to listen to. Yes, that was a plug. You can go and have a look at our podcast on your podcast stream or on our website called Your Money Talks. So in conclusion, things are tough right now, and they may well get worse before they get better in the short term. However, the short-term view is not the wise option here. Money grows best when it is properly diversified and granted patience. In time, and maybe not that far off, Mr. Trump may well start pulling very different levers that suit our client portfolios far better. If you need anything, you know we're here for you.